stable operating margins, strong cash generation, strong large deals, and increased employee headcount. Our revenue grew 3.1% quarter on quarter and 3.3% year on year in constant currency terms. Financial services grew at 2%, manufacturing double digit, energy, utilities and services at 5.8%, all quarter on quarter. We saw growth in all geographies quarter on quarter. Our operating margin for Q2 was 21.1%. The financial services segment in the US continues to see discretionary spend increase in capital markets, in mortgages, cards and payments. We've seen slowness in the automotive sector in Europe. Apart from these verticals, demand trends remain stable, with clients continuing to prioritize cost takeouts over discretionary initiatives. We are deepening our work in generative AI. We are deploying enterprise generative AI platforms, building our own small language model, and developing multi-agent solutions for our clients. With our strong performance in Q2 and our current outlook, we have revised our revenue growth guidance for financial year 25. The new guidance is 3.75% to 4.5% growth in constant currency for the full year. Our operating margin guidance remains the same at 20% to 22%. With that, let's open up for questions.
Thank you, Salil. We will now open the floor for questions. As always, we request one question from each media house to accommodate everyone over the next hour. Joining Salil is Mr. Jayesh Sangharajka, Chief Financial Officer, Infosys. We have the first question from Ritu Singh from CNBC TV 18.
Hi. First on the guidance revision, if you could break down for us, how significantly altered is the demand environment now versus what you saw a couple of quarters ago? And how much of this revision upwards is organic versus the contribution that you're seeing because of the Intech acquisition? One, if you could begin by telling us that. Also, there have been 7 revisions in the revenue guidance in the last 8 quarters. Could you tell us what you have in terms of visibility now, in terms of the turnaround that you're speaking about? Financial services is something that you've highlighted, but some of the other areas of concern that you've been speaking about, retail, high tech, etc. What are you seeing there? What are you hearing from clients on discretionary spends? And if I may, also a word, your headcount has increased for the first time perhaps in 7 quarters. You told us last time you're looking to hire about 15 to 20,000 freshers this year. Are you on track to do that? And if I may, add another question on guidance while we're talking about this. You've maintained the guidance for margins at 20 to 22%, but you've deferred the wage hikes to the third quarter. How much will be the impact from that? And there was no real expansion despite this Project Maximus that you've undertaken. Just give us a sense of why, despite what we saw with the rupee, why that didn't happen, and how much of a hit do you anticipate in the coming quarter because of the wage hikes? Thank you.
So let me start off with some of the ones that you asked, and then Jayesh will add a little bit on the margins and also on the revenue growth guidance. So first on the revenue growth guidance, the way we look at this is based on what we've done in the quarter. Then we look at our pipeline and look at what we anticipate. And based on those factors, as we sit today looking out for this financial year, that's Q3 and Q4, we've looked to increase the revenue growth guidance. Now, part of it is the second question you asked on the industries. So we see financial services, discretionary spend is looking stable, strong, especially as we highlighted in capital markets, cards and payments. We also shared that in automotive, we see slowness in Europe. In the other verticals, the discussions with clients are similar. So we don't see any change. There's no new discretionary, and especially the verticals you mentioned, retail or high tech. What we do see is more focus on the cost takeout elements there itself. In terms of the margin piece, let me first hand over to Jayesh, and then there may be some other comments on the revenue itself.
Yeah, so just to add to the guidance piece that Salil was talking about and to your question on Intech, If you recollect, last time when we announced the guidance, we had clarified that Intech is now completely included in the last guidance. So there is no additional impact or additional benefit this quarter on account of Intech. It was already baked in the last quarter's guidance. Having said that, there are multiple factors that we look at when we give guidance. A strong H1 performance, the pipelines in terms of large deals, and less than 50 million deals that we have. Our less than 50 million deals have also increased double digit this quarter, so that has also contributed to increase in our guidance. Coming to your margin question, if you look at our margin this quarter, margin has remained steady at 21.1%, similar to last quarter. And if you look at the puts and takes, we got 80 basis points of benefit from Project Maximus, 10 basis points from currency. That was offset by 30 basis points on account of acquisition because of the amortization of intangibles. And the 60 basis points is on account of the salary and the variable increase that we provided, as well as the other costs. So Project Maximus has been contributing. It's offsetting the comp increase in the variable additions that we are doing. So that's baked in our guidance. We have guided for 20 to 22%, for the full year. At this point in time, we are confident of our guidance, with the wage hike that we are planning in Q4. The wage hike is going to be in the phased manner. Some part of that will be effective January, and the balance will be effective April.
Thank you.
Go ahead. Yeah. So sorry. We are on track to onboard the 15,000 plus freshers that we talked about last time. We have onboarded many of them in the first half, but we are on track to onboard 15 to 20,000 at the group level in FY25.
Thank you. The next question is from Haripriya Suriban from NDTV Profit.
Hi guys. Salil, if you could give us a sense on the budget's opening up, right? The US Fed decision and the elections also coming to a close now. More stability is expected, at least in the US markets. So how do you see that in your conversation with the clients? Do you see more budgets opening up? Does this mean that Q3 and Q4 will be significantly better? Also give us some sense on the growth you're seeing in the emerging markets, because we see that it's an up and coming opportunity for other players as well. So how is it panning out for you? And on the margins, just to double tap on that, you have been on the lower end of your guidance consistently now. So do you think with the markets getting better, demand coming back, that should also translate into better margins, and you probably reach the higher end? And on the fresher hiring, you have mentioned your goals there, but with the new AI roles coming up and so much of work with generative AI, do you think you'll do more specialized hiring, and will the salaries be better there, even on the fresher level and the lateral hiring?
So let me start off, I think, first on the budgets, and then a little bit on the emerging markets, and then Jayesh will add on the margins, and he'll come back on what's going on with generative AI. On the budgets, what we see today is, in financial services, we're starting to see the discretionary spend improving. We shared that last quarter, and we see that continuing as we saw this Q2 rollout. In the other industries, in automotive, we still see the slowing in Europe, which we referenced before. And then for the other industries, whether you look at retail or high tech or telco, we still see the discretionary spend part of the budget is constrained, and there's still much more emphasis on the cost and efficiency discussions. On the emerging markets, in that sense, our presence is much more in Western Europe, in US, Australia. Though for us, some of the newer growth markets, we do see good traction in Japan, good traction in Middle East, but relative in terms of size, they are still quite small, but a good outlook in those markets.